Welcome back to EDS, and in this video I'm going to show you one simple strategy that you can implement to generate consistent returns year on year in your portfolio. So the first thing that you want to do is navigate to any equities underlying in your portfolio. We've got BA open right now. It doesn't matter what you pick, and you want to navigate over to where you can see a list of expiration dates for the options contracts that are traded on that underlying. It's currently it's currently a Sunday. The market is closed, but we're just going to mock up a position. We're not going to send any orders. We're just going to mock up a position. I'm going to show you exactly what to do step by step. So at this point, we can see a list of expiration dates for the options contracts that are traded on your chosen underlying. Now, we want to choose an expiration date that's between 30 and 60 days out in time, and it also needs to be a monthly, not a weekly or quarterly expiration date. Now, the one that's closest to fitting that criteria is February 21st, 2025, with 61 days left on that contract. Now, we're not going to be buying any options contracts, but we're going to be selling the options contracts. And I'm going to show you why as we go through the video. So February 21st, 61 days out in time. Now we can take that information, come over to our watch list. This is a pre-made watch list. You can use any watch list that you like. And we simply want to filter out any and all underlyings that have an earnings event over the next 61 days, because that's the length of the contract that we're going to choose. Now, the reason for why we want to filter out earnings events is because earnings events increase volatility. They have the potential to ruin our deltas or cause disruptions with our deltas. Both of these things will have a negative effect on our P&L. We also want to remove any underlying that has a low liquidity rating level. This is because we only want to be trading liquid markets. Liquid markets means tight spreads. The spread is the difference between the bid and ask price, and the spread is what you pay every time you get in and every time you get out of a position. The tighter the spread, the less you pay, the more profit you keep. So at this point, I personally like to order everything from high to low IVR. IVR is IV rank. This tells us where IV is relative to that specific underlying over the past year. The higher the IV, the better for us. We are going to be writing and selling these contracts, which means that we are going to be short the contract. And anytime you're short something, you want to sell high and then buy it back lower. IV, the higher the IV, the higher the volatility, the higher the options price. So you want to sell when the options prices are high, i.e. when volatility is high, and then buy it back as volatility contracts. So this is why we want to order everything from high to low. Now, generally speaking, anything with an IV rank of 50 or more can be considered high. However, even over 30 can be considered high. It just depends on what's happening in the market. So you want to keep in mind with what's already in your portfolio. Make sure everything is nice and diverse. Don't go too heavy into any one sector or industry. And you simply want to go down the list, see what would fit well, and you want to make sure that the size of the underlying itself is at least around $40, $50. Generally speaking, above 60, 70, and above there is better. The bigger the underlying, the more buying power that's going to be required, i.e. the more money you're going to need to have in your account to open the position. But I'm going to show you a way that allows you to trade even big positions in a small account. So we just go down the list, and just to hammer home on the point that sometimes even an IV rank of over 30 can be okay, I've just managed to spot AVGO, which is currently trading at a little bit over $220 a share. It's got an IV rank of 43.4, and it's got an absolute IV level of 45.7%, which is quite nice, to be fair. So we're just going to go over to the expirations list for that specific underlying. And the reason why at the beginning of the video I said it doesn't matter which underlying you pick at to initially lock in on an expiration date is because, as you'll notice, all equities have the same expiration dates. So for AVGO, February 21st, 61 days out in time, we've already locked that in. So now we're going to be presented with the options chain. Now this is where we can choose exactly which contracts we want to be buying and selling. So this orange horizontal line shows us where the price of AVGO currently is with respect to the strikes. this vertical orange bar shows us what the expected move is of AVGO over the next 61 days. And what we want to do is we want to have a very high probability of success. We want to be trading like a casino. We want to have, for every 10 trades, if we can win 9 of them and only have to worry about managing the risk for one of them, that's much easier than if it was the other way around. So we want a very high probability of success. And the way that we're going to do that is by selling contracts that are outside of this expected move. So when we're selling a contract, it means that we don't want price to go near that contract. We don't want price to go past that contract. So we're going to sell outside of this expected move. And how do we know how far out? Well, we've got the delta column here to look at, and we want to be selling contracts anywhere between about 15 and 20 deltas. So on the call side here, we've got a delta of 21, which is currently at the 260 strike. Now, you'll notice that the spread here on the bid and ask are quite wide, but that's because the market is closed. As soon as market opens tomorrow, this will tighten up and everything will go back to normal. But just for the purpose of showing you how to do this, we're going to carry on. So we've selected our contract to sell on the call side with a 21 delta, and we're just going to do the same thing on the put side as well. We've got a 21 delta on the put side at the 196 strike. So that's going to overall give us a overall delta on the position of 0.31, which is near enough delta neutral. Now, as you can see here, a green bar has just shown up, and what this green bar shows us is where our break-even points are. So as long as price stays within this green bar, we will make money in 61 days time. Now, what you'll notice is this green bar overshadows this orange expected move, which is going to lead to a very nice and high probability of success. And as we can see here in the bottom left corner, we've got a probability of profit of 68%, which means that at expiration in 61 days time, we've got a 68% chance of making at least 1 penny on this position, which is a very, very high probability of success. Now, what we can do is, instead of waiting until all the way to expiration, what we can do is simply exit the position once we've hit 50% of our max profit. And if we were to do that, we've got an 83% chance of being able to do that at some point between now and the next 61 days. So very, very, very high probabilities of success that we are looking at. Now, how much money can we actually make off this position? Well, this number down here shows us what we would be able to. This is the mid price of this position. This is the order on the bottom left, and this is the mid price. So we'd send this order and try and get filled at the mid price, which is $9.60. Now, each options contract controls, for equities at least, controls 100 shares of the underlying. So you would multiply this out by 100 to get our max profit, which is shown here. So at the point of this trade being filled, we would collect $960 upfront in premium. Now, this is our max profit. So if you wanted to take profit at 50% of our max profit, it would be 50% of this number here of 960. Now, what's our risk? Well, we've got an unlimited loss potential here. Now, don't worry, because you wouldn't actually be forced to take an unlimited loss as long as you know how to manage risk correctly. And in order to open this position, our broker is going to require just under 6.7k in buying power to open this position. So it's going to require just under 6.7k, but we collect almost $1,000 up front, which is a very nice return on capital for a naked position like this, with such high probabilities of success. Naked simply means that there are no long contracts covering our short contracts. That's what naked means. And if there were long contracts covering our short positions, that would then make a covered position. Now, 6.7k is probably too much for most people's portfolios, especially to allocate to just any one single position. And also, some people might not feel comfortable with having a unlimited max loss potential. So what I'm going to show you how to do is turn this position into a defined risk position. And you're going to see how the numbers change as we do that. So what we're going to do is simply come down one strike below on the call side and buy this contract. So we've sold the 260 and we're going to buy the 265. And then we're going to do the same thing on the put side. I'm going to buy a contract $5 wide. This is $5 wide on the call side. We're going to do the same thing on the put side, $5 wide. Now there isn't a strike at 191, so what we're just going to do is we're going to drop down 1 delta to the 20 delta, which won't make too much difference. And we're simply then just going to buy that contract there at the 190. So the reason why we did that was simply just because there wasn't a 191 strike, and we want to keep it $5 wide on both sides to keep the risk the same on both sides. So what you will have noticed is we now have slightly lower probabilities of success, only slightly. However, our buying power requirement has now significantly reduced. It's no longer 6.78k, whatever it was, it's now $330. Now, the premium that we collect has also reduced. However, from a return on capital perspective, your return on capital is now much higher with a defined risk position like this, as opposed to the naked position equivalent. Now, in exchange for the high return on capital, we have a slightly lower probabilities of success. That's the trade-off that we make with this. But it just depends on where you are at in your portfolio and how much money you have to play with. Now, how much buying power should you be allocating to your positions? Well, in order to know that, we've created a free position sizing template. The link is in the description. And the way it works is you enter in the size of your portfolio. So let's say if it's $25,000, you'll then enter in whatever the current VIX level is, say if it's 19.2. Below that, everything will be automatically calculated for you. And at this point, you simply just need to use this information to form the backbone of your portfolio. It will tell you the maximum amount of buying power that you should be allocating to any single defined risk position, undefined risk position, how much of your portfolio you should be allocating to short premium strategies in general. And there's also an explanation of how everything works here. Now, if you want to learn in more detail about what we do and how we do it, link is in the description. This time, click on EDS Premium and get yourself signed up. Inside, you'll have access to our portfolios that will allow you to see the positions that we're placing, how we're managing risk, how we're making adjustments, all in real time. There's also a full course, so no prior knowledge is required. We will teach you everything that you need to know from start to finish. This allows you to learn the theory and then see how it's applied by seeing our positions that we're placing all in real time. If you get stuck at any point, it is a private community, so you can speak with myself directly or with other like-minded individuals. And there's also a 100% money back guarantee. So once you have studied the full course and followed our positions for at least 6 months, if at that point you haven't been profitable, then we will work with you for free until you are, or you can simply request a full refund. So it's completely risk-free on your part. Right now, we've just launched, so it's so cheap to get in at £1 a month. The price will be increasing. However, once you're in, the price is locked in for you for life. So you are definitely rewarded for getting in early. And the aim of EDS Premium is to get you to a point in 6 to 12 months where you are completely self-sufficient, you know what to do, and you know how to write options contracts profitably, and you know how to do it for the rest of your life without any external help or influence. You are, of course, always welcome to stay and be part of the community. However, 6 to 12 months, you should have learned the skill, and it's something that no one can ever take away from you, no matter what, for the rest of your life. So with that being said, I will see you guys on the inside.